This will be a brief presentation of a financial model for a retail SaaS company with 4 revenue sources, which are revenue from subscription, from advisory sessions, from the interest received on the common savings pool, and the part of this interest is retained by the company, and finally by advertising. Also, the model is made in such a way to work for 2 separate markets. The idea is that the product for which the subscription is paid is first introduced in one country. In this situation, it is the UK, and then at a later period, it is introduced into another market. So you can see here that the assumptions that can be set in the model are fairly granular. You can start with setting the total market size from which serviceable market is calculated, and finally obtainable market share. You can set subscription prices for different packages, basic, premium, and VIP. You can set how much users are expected to save per month, depending on the package they select and on users' demography. You can set interest rates depending on the total amount of money in the common savings pool and the duration of savings. You can also set for advisory spending how likely the users are to use these sessions, how many are used per year per package, and how much each session costs, etc. Projection of the user count is very detailed. It takes into consideration the total obtainable market for each country. Also, churn rates, as you can see, you can set them separately because the assumption is that user churn would be the highest in the first month and would decrease later. So to give you a general overview, let us zoom out, and you can see that this is a very detailed approach, cohort-based calculation, to calculate the user count for each country and churn as well. Users and revenue calculation is also very detailed. So let us take a look in the UK. First, you set the basic assumptions. Here you can set the probability that, for example, a basic user is going to switch to premium package in the next month. And also you can set the probabilities that users are going to decide to downgrade, for example, from the VIP package down to premium. Then user count per package is calculated in this section here. We have a separate subsection for the so-called early adopter calculations. We have separately users who join after that initial time period, and finally total user calculations. In the next section, we calculate the subscription revenue with all of the upgrades and downgrades per packages. Savings section is below it. It is also very granular because we need to consider how much money each user is saving in a given month, and all that money is then joined together into a common savings pool, which we need to track how long money has been saved, because the interest rate depends not only on the sum but also on the duration of the savings. And in the section below we can see the total savings amount finally grouped by duration in months and the interest which is received for all of these savings. The next section deals with advisory revenue or revenue from advisory sessions. And finally, we have advertising revenue. All of these sections are calculated for the another market as well. Expenses in the model are set in 2 sheets. Those are the non-wage inputs and headcount inputs. In the non-wage inputs, you can see that expenses have been grouped by types. You have general and administrative expenses, tech expenses, marketing and branding expenses, and other expenses. These have been defined by the client. Now, the interesting features are here, where you set the expense type, its driver, whether it should be included in the sales and marketing, when a certain expense is supposed to be initiated, when it's supposed to end, and finally the monetary amount. Now, the formulas which calculate expenses, as you can see, are fairly complicated, and this formula is ready to take and calculate anything that you throw at it. So for example, if I say that the expense is supposed to be spread evenly, that means that the rate given here is applied the same in every month. But I can change it, for example, and say that the cost is supposed to be calculated per employee. In this case, you can see that this would become very expensive because the company would pay 500 euros per month per every employee. For the purposes of this demonstration, I can say that the company has to pay this amount of 500 euros per user, which is obviously unrealistic, but let's see what happens. The expenses grow to 200,000 euros in the second month. So you can see that whatever I set here in this drop-down menu, it will be forwarded into all of these formulas, and the model contains projections for the next 60 months or 5 years and will calculate appropriately. A very similar principle is applied in the headcount inputs. The income statement can be seen as monthly income statement, or I can switch to a quarterly view, or I can switch to the annual view. Also, one thing that I can change is the currency of the income statement, and we would set it in the assumptions sheet. So you can see that all of these cells now represent amounts in dollars. I can switch it, for example, here to euros, and based on the exchange rate, the entire income statement will instantly change. The dashboard of the model will show you first in the top section the key data. So you can see that under these assumptions, the raised equity is expected to last for 19 months, and in August 2022 we are expected to fall below zero. To change this, I can go to assumptions and parameters and raise the initial cash balance, which I can set, for example, to $1,500,000. And now if I go to the dashboard, you will see that the raised equity is expected to last forever, which means that the negative cash balance will not show up ever. The break-even analysis also immediately shows you what is the break-even month and how far from the initial month it is. It also shows you the payback period, in what month the payback of the initial investment is achieved, and how many months from the beginning of the model the payback of the initial investment is attained. Then you have a number of charts showing you all kinds of things. The final section, which we are going to cover, is the DCF valuation model, the discounted cash flow. The cost of capital is set in the assumptions sheet, as are the initial funds. Here in the DCF sheet, what you set is the terminal growth rate and the exit EBITDA multiple, because the DCF valuation in this model contains two projected equity values. One is derived from the terminal growth rate, and the other from the exit multiple, in this case the EBITDA multiple. So you can see that this company is valued with these assumptions at between 95 and $100 million. Finally, the DCF sheet contains two sensitivity tables which enable you an instant view of the estimated equity value, provided that key parameters of the DCF model change. In this first table, we see that if we change the perpetual growth rate and also assuming a different weighted average cost of capital, how the equity value will change significantly. The second data table also shows how the projected equity value changes, but this data table is connected to the equity value projected from the exit multiple, not from the terminal growth rate. So instead of changes in the terminal growth rate, here you can see how the projected equity value changes if we change the exit multiple. This concludes the presentation, and I thank you very much for your attention.